In fact, we are, Aisha is having a conversation with Samiran Chakraborty. He's India Chief Economist, Citi. Let's listen in.
The economy. Till now, we haven't seen that much of pass-through of raw material cost increases into core inflation. Is this a more lagged story? And to what extent the core inflation numbers stay higher than usual? I think these are the three things that I would be watching more closely now.
Samiran, I was just going through your latest research, and that calls wages an underappreciated tool and a driver of consumption green shoots. Tell me, what is the prognosis for this?
Yeah, it's a very interesting thing that India does not have a kind of one particular wage data which everyone can track. So you have to glean it out of multiple sources. So in this report, we have tried doing that using both the official, mostly the official estimates and some private estimates. Uh, so what we are figuring out is that uh, something changed around 2025, and then it's following through in 2026 also, is that in multiple ways there has been improvement in wages, not only in our tracker of about 4,700 listed companies' wage cost data, where the wage cost growth has been better in 2025 or rather FY26 vis-a-vis FY25. But also in the government's PLFS data, we have seen increase in wages, particularly for the salaried class. And now we are seeing across the board in quite a few states a substantial increase in minimum wages that have been done. And now, how quickly that gets translated into other states also doing the same, and at the low end of the private sector also sometimes gets impacted their wages by this change in minimum wages by the state governments. And then once this minimum wage revision process is behind us, then next year is the eighth Central Pay Commission year. So we have done some estimates on how much of a wage increase could happen next year. So in all, from 2025, 26, and 27, all 3 years looks like there would be substantial increase in wages, which could be one of the reasons why consumption side of the economy has held up quite well.
Interesting. And you've also made the point that Karnataka's minimum wages are up 50 to 60%, Haryana 40%, and Uttar Pradesh 28%, against a usual annual trend of just about 6%. What does this kind of state-led wage shock do to manufacturing competitiveness versus its, of course, boost to consumption?
Yeah, it's always a difficult balancing game, right? We have to look at it that for the minimum wage has two component. One is the base wage, the other is the variable dearness allowance or the VDA. So the states usually only increase wages to the extent of this VDA and not change the base wages for a very long period of time. So in some sense, one can say that this was due, and after this new code on wages that has come in from November 2025, I think most states are now going ahead and doing that base wage revision, and that's leading to this one-time shift. So yes, I mean there will be some pressure of this into the overall wage cost for companies. But the point that I was trying to mention is that there's no perfect correlation between minimum wages and any other wages. Minimum wages are more kind of statutory in nature. It's more a guidance than anything else. The central government is working on fixing a national floor level minimum wage, which will be kind of binding on states to follow. But that process is still on. But to me, the big question is that how quickly this gets translated into actual wages on ground.
But tell me, what could be the implications or the multiplier effect of this? Because you write in your notes that the Eighth Pay Commission's fiscal impulse is going to run to about 1 to 2% of GDP over FY 28 to 29, even at a conservative fitment factor of 2 and a 2.5 odd percent. Tell me, what happens to the fiscal math then, and then to inflation?
Yeah, so this is obviously every time this pay commission happens every 10 years, this is a shock that the fiscal will have to absorb. I'm pretty sure that everybody in the scheme of things are well aware of this. So there are multiple ways to address this. I mean, in past, we've written about it that one of the ways to do it is to use some of the cushion that is there in the RBI's balance sheet and transfer a bit extra money for one particular year as RBI dividend to the government, and through that plug the hole. There are other ways of doing the area payment in tranches so that it gets the fiscal impulse is spread over multiple years. And you could think of doing larger amount of divestment also on particular years. So there are multiple ways to address this, but it's quite clear that once this fiscal impulse comes in, if our numbers are anywhere close to right, then there will be a big consumption boost also. And in turn, that should increase the tax revenue as well.
But just to draw a deduction here, Samiran, is there any which way that the wage story could undercut the consumption recovery story rather than support it? Or should one assume the wage story being a big tailwind to the consumption story?
So for us, it appears to be a big tailwind for sure. I mean, our equity analysts are constantly upgrading different consumer stocks at a time when we thought that because of this energy crisis, the Middle East crisis, there will be pressure on consumption as well with fuel prices, etc., going up. But that has not happened. I mean, in fact, one of the reasons for our inquiry into this whole wage process was to better understand that what is making consumption hold up so nicely. One part could be that we have given, both from fiscal and monetary policy side, a large amount of stimulus in 2025. We estimate that the income tax cut, GST cut, rate cut, CRR cut, everything combined is about 1.3% of GDP total stimulus that has been given. So we are seeing that stimulus pass through the system now, as well as this wage part. And another part also needs to be discussed, which is that the consumer credit has also grown quite substantially. So if you put all of this together, the consumption side of the economy looks to be holding up or been much more resilient in the face of multiple external shocks.
Big relief to hear that coming from you, Samiran. But the other thing that you've always flagged off is AI and the automation story as a key downside risk to wages in IT and financial services. And, flagging it off from the Aon data, which already shows tech consulting salary growth slowing to about 6.6% for 2026. Is this the first hard evidence of the AI disruption you did warn about back in May?
But there are obviously everybody can look at it with different lenses. But just to first put the numbers in context, I mean, that 4,700 listed companies' wage cost data that we track, what is interesting is that, and it's kind of the total wage cost for these 4,700 listed companies is 18 lakh crores of rupees. So it's a big number. And what we find is that almost 50%, 48% to be precise, comes from just the IT and finance sectors. So there is a heavy concentration in that white collar jobs from just two sectors. And these two sectors are the most likely getting disrupted by this automation AI kind of stories. So I can see that different people are writing about the employment numbers also. When these company results come out, they declare whether there's enough job growth in these companies or not. So that's one way to track how much impact is coming. But we thought that another way to look at the same thing could be the overall wage cost number, which is nothing but the employment multiplied by the actual wages being paid. Another way to track this would be the monthly service exports numbers. We are watching this also quite closely. Last 2 months, the service export growth has been somewhat more tepid. Before that, we were saying that service exports are growing at double digits. So from there, the sudden deceleration in growth is something that I think we need to all watch out for very closely, because it has implications not just for the BOP, but the overall consumption story as well.
Samiran, the El Nino intensifying and, rainfall deficit is widening through June and July as well. How much of the food inflation uptake, cereals, protein, edible oil, is monsoon driven versus the wage-led demand pull that you're now describing?
I think it's pretty very, very early to say it's a demand pull. It's if at all, this is more a supply side shock that we have to be concerned about. Having said that, we've looked at this data historically on in drought years, what kind of food prices get impacted. It's not a big surprise that actually food grain prices don't get impacted as much. The stock of food grains that we have, rice, wheat, etc., is so large that it's relatively easy for the government to provide those stocks into market supply and then keep prices under check. If at all, the price impact is visible more for items like pulses, oil seeds, and vegetables. So the critical question for us market analysts is that uh, at what point of time would this be visible? We had a very good winter crop, so it is possible that that winter crop of vegetables will last us all the way up to even September. So maybe, if at all, the price impact is visible more from October onwards. The counter thesis is that if the rainfall deficiency is this large, would some speculative element build up happen in prices like vegetable prices, where the price increase will be much before what the supply demand balance would suggest? So that's something that we are very consciously watching. We have taken about 40, 50 basis point of additional just El Nino related effect on our food prices into our inflation forecast. But given how the actual rainfall pattern will play out, we might have to either up that number or lower that number. So that's kind of the baseline forecast that we have for now.
Samiran, you've called this the third consecutive BOP deficit year, unprecedented for India so far. The current account deficit is now tracking near 1.5% of GDP for the quarter, wider than your earlier full year estimate. Is the deterioration happening faster than you anticipated?
No, I would say that our BOP numbers have gone through a massive transformation just because of the new schemes that RBI has announced to get the one-time dollar inflows. The FCNRB scheme, the ECB scheme, as well as the OFCB scheme for banks borrowing. All three schemes put together, we are thinking at least $60 billion could easily come in in a very short span of time. So in some sense, the entire BOP deficit forecast that we had when we last spoke, that can be easily covered by these inflows. On top of it, oil prices have also come off quite materially from the numbers that we had seen in May. So our global oil strategists are now looking at oil at 70 or below. And in that sense, it's a very good news for India. Our own current account deficit forecast have been materially reduced based on that lower oil prices. We are now probably, in our forecast sense, tracking below 1% of GDP current account deficit. So if you put all of this together, we are now closer to $45 billion BOP surplus forecast for FY27 rather than the 50 billion BOP deficit that we were looking earlier. So I would say this external sector outlook has gone through a pretty sharp turnaround because of partly how the geopolitics situation globally has changed and partly because of the policy measures taken by RBI.
All right, you can catch that full conversation on the interview by Aisha Faridi only on ET Now.